2017, I went up to 500. I went up 500%,
Yeah.
then dropped 70%, and that was my first learning curve. And
Crypto?
then this time, yeah, and that was Bitcoin and stuff like that, the cryptocurrencies. And then and then recently it was a similar thing. Cryptocurrencies did amazing. I took some profits that saved the portfolio, to be honest. And then it crashed again. But what I did this time was I took some profits and I invested them into things that hadn't performed as well as crypto, but were more stable. So this is when I started, like, I've been doing this for a while, but trying to do more value investing, which is learning a few combining metrics with real world fundamentals in order to understand what stocks am I getting at a good price.
Yeah, that's also for my viewers. Harry is a popular investor, and in his bio, you have his strategy where he talks about the Benjamin Graham strategy, value investing, etc. I still watch your YouTube channel. You have the most entertaining YouTube channel out of every popular investor
Wow.
on eToro, and I love your editing. You present
Oh, thank you very much.
topics like Warner Bros, some niche topics that nobody wants to hear, or maybe that's too niche. It's not sexy. It's not Nvidia, Tesla. And so I like it. You talk about amortization, talk about other stuff. It
Yeah,
changes the YouTube sphere of finance.
that
So congrats.
that's a lot of YouTube comments, YouTube videos just follow the FANG stocks, and I think a lot of people just think that the top of the the whole stock market is just 10 companies, and so whereas I think Buffett's approach is that he doesn't even see a stock market; he just sees it in a world of investing, and occasionally the stock market is presented at favorable prices. Right now, I think the stock market is a bit ludicrous. I think it's a bit overpriced. And so, I mean, I did do a video on Nvidia recently, only to show people what ludicrous means to me, because it could well be that Nvidia comes out like their earnings could grow astronomically from here. They've got, like, almost a 20-year advantage on AI computer chips and stuff like that. So the question is, how long would it take Microsoft or Meta to, like, catch up with Nvidia for their own services? Because they don't necessarily need to produce Nvidia chips, they just need chips for specific tasks. And so that's what I can't price. That's what I struggle to price. So that's why I look at things like Warner Brothers Discovery or Greg's or Crocs, because I can see their growth and I can understand, I can measure the impact of their competitive advantage, how hard it is for someone to show up and compete with them.
What is Greg's about? It's like kitchen hardware stuff.
Have you been to, so if you visited the UK, you might have seen them. They are a bakery.
Okay.
There's about 2,000 of them across the UK. They're sort of blowing up. They're popping up on every high street, and they've also started doing drive-throughs and stuff like that. I think, to me, Greg's is McDonald's in the 1940s.
Okay. So
And
they have 3 projects.
they're you can go in, get a really decent bacon roll and a coffee for £2.65.
Okay.
And in the UK, that is unprecedented. And they have a sausage roll that's like £1.20 or something like that. And the way that they do it is they kind of produce baked goods the way Coca-Cola do. They'll have a massive warehouse. Everything's made in a warehouse, then shipped out to their 2,000 locations, where they just heat them for 5 minutes or 10 minutes, and then serve them. So that's how they're able to do it so cheap. And the competitive advantage is, how hard would it be for someone else to build a warehouse that with 2,000 locations? Like, that would be incredibly hard. McDonald's can't do what Greg's are doing because people expect to get a burger from McDonald's, so they have to do things on site. So a Greg's shop will have 4 staff at a time, and McDonald's have to have 10 to 20.
Okay. Okay. I don't know at all the bakery industry, so I don't know if there are many competitors in this industry. Have you looked at competitor? If there is any competition?
In my opinion, for what Greg's is, there isn't much competition. If you're just running to the train station, there's plenty of competition, but none compare when you pick the price level. So if you're trying to get hot food on the go, there isn't much competition. You can't get a bacon roll and a coffee for the same quality at £2.65.
Oh wow.
Mm.
Okay, that's good.
Anywhere else. So yeah, that's what, but that's not really like, I think everyone, the YouTube channel is kind of getting everyone that ability to look outside of the top FANG stocks. I have my own. I do invest in them monthly, and I would buy them if I saw them at awesome prices. But I buy them monthly in my Vanguard fund. I still love the S&P 500, but
by the way, I just looked at your portfolio. I saw
oh yeah,
Greg's. I saw some Oatly company, a company that
yes,
a lot of finance influencer pitched.
mm-hmm.
And I saw Coinbase as your first position and some met coal company.
Yes.
I loved to see. So we are on the same boat here.
Yes. Oh, you got Met Coal as well.
Oh yeah, AMR.
Yeah. And so what turned you onto that?
I'm sorry?
What made you pick Met Coal or AMR?
Uh, a cloning strategy of Manish Pabrai, who
Yeah.
cloned David Einhorn. And Manish Pabrai said something about the medical industry, about the guaranteed cash flow because of long-term contracts. So I did some digging and saw these contracts with fixed price, fixed volume, and did the complete analysis myself to be sure of this copy strategy. And okay, I said I like it. I like the strategy. In the earnings call, management clearly said we won't do any dividends. The stock is so cheap. Every cash we produce will be used toward buybacks because I quote, our stock is criminally undervalued. So you don't often hear this. And yeah, I didn't know the medical industry at all. So I'm still a very beginner with this. And I bought last August, I think, and it's almost a double at this time.
Yes.
And if Manish Pabrai or David Einhorn, if they don't sell, I'm not selling. I'm as stupid as it is. Just
Yeah.
pure cloning strategy. Once they start selling, I will question this this bet. But that's the bet I'm making. It's just 5% of the portfolio, not insane.
Yeah. I don't know how long I'll hold on to it for, but yeah, I saw it the same way you did, Manish Pabrai. I hadn't looked at the earnings call, but I saw that they were buying back shares. They were like price to earnings of 5. Earnings relative to their price were just ridiculous to the point where they didn't need to grow to pay you back in 5 years. So I don't see this being an incredibly long-term thing, but while everything else in my eyes is deemed overvalued, having these earnings which are near guaranteed is it like it's like an amazing premium bond account.
Yeah, and it's good to have finally some bet which is cheap and going the right direction. I'm talking about China right now.
Yeah.
We have some great deals, insanely cheap, and then the stock is
Mad.
going nowhere for the past 2 years, have been nowhere.
But
So
two,
yeah,
two
that's
years
good.
is an incredibly short period of time. I think the US and China, it like I can't predict what's going to happen there. But I watched an interview with Charlie Munger, and I thought what he said was interesting. He believes that since the war in Ukraine, the likelihood between conflict between the US and China has gone down, not up, because the Russia thought they were just going to get Ukraine. He didn't expect the West to be as aggressive as they were. And I think China thought the same of Taiwan. And so I think they're not stupid, but it is mad that quite a lot of US companies now are larger than China's entire stock market.
Yeah. Yeah.
And so what is it? China produced something like 30% of the world's goods. And so what's going to, a manufacturer that produced 30% of the stock for the world, what's going to perform better, 30% of the stock for the world, or these companies, these individual companies in the US? It may well be the US companies because there's a lot more margin in the stuff that they do. But yeah, there's no doubt that the Chinese companies are being sold at such a massive discount right now.
Oh yeah, and some of these companies in China are way better than the companies we have in the US or in the UK. In the UK, for the FTSE, you only have banks and energy, and the index is going nowhere because of all this concentration of these sectors. For China is quite diversified, but if you look at history, the Chinese stock market has been trading cheaply for the next decade, for 20 years. So right now we have a PE of 6, 8, 10, something like this, like quite cheap PE ratio for China.
Yeah.
I don't think it can go to 25 soon. I don't think there is a re-rating,
No.
maybe from 10 to 14, but nothing crazy.
Yeah. But then let's say 10 years, right? The S&P 500 can't go higher in PE ratio, can't go meaningfully higher in PE ratio from where it is. And so in 10 years' time, you're kind of counting on the earnings to have grown almost linearly that entire period for all of the companies, and for it to stay at 25, 30, wherever it's at right now. Whereas China, if that performs well for 10 years, then that PE ratio probably will be 15 or 20 or something like that in the next 10, 15 years. I think the China's stock market was started in 1996. So it's only in 2 years' time, it will be 30 years old. Whereas the US stock market is like 500 years old and stuff like that. So I think a lot of skepticism is being priced into it.
Yeah. We see things can change. We've seen in Japan that things can change. India, things can change. In China, we will see. And I see some news for PDD that is growing really fast. JD.com is looking extremely undervalued, maybe more than Alibaba. Tencent is just a beautiful company at a fair price, cheap price. But yeah,
I'm considering rather than having Alibaba in my portfolio, having China's index fund.
Yep.
Because I'm not living in China, I can't accurately see what their competition is like. But the way I kind of look at some investments is like, yes, diversifying makes it easier to, it means you can put less work into each stock. But at the same time, I would want to know everything about each of those companies. So if I pick up 2 more, I'm going to have to do research. So even though there might be, I looked at some of them and it looks like JD, it might be potentially better than Alibaba at this current price, but I just can't afford. I can't afford to invest the time into analyzing JD on top of Alibaba. So I'm just going to commit to the. I'm going to act as if I'll get taxed if I close Alibaba. I wouldn't get meaningfully taxed on it, but it's all about having a big enough pile of eggs so that 1 or 2 of them can be bad and then the rest should outperform it.
Yeah, like Money February said, you want China with a wide brush. You don't want to be very specific. Just invest in Chinese tech or something like this. Nothing specific, because we don't live in China. So we don't have the opportunity to experiment, to test the products, the services.
Like a big investment for Buffett that changed the course of the Berkshire Hathaway's history was Amex. And when Amex crashed because of It was like there was this big oil scam, and what they were doing is there were these vats of oil that were valued at like 25 million or whatever, or 25 billion at the time, and all it was is they were filled with water, and at the top level was water. Was oil. And so when they tested them to see if they were filled with oil, they tested from the top and like, yeah, this is filled with oil, therefore it's valued at 25 million or whatever. And then it came out that this was all a lie. And people found out what the guy was doing. And the share price of Amex crashed. And all Warren Buffett did was he went down the high street and he sat next to cashiers at restaurants and he watched and saw how many people came in with Amex cards. And he asked people about whether they'd even heard about what was happening. And they were like, no. And so he looked at their debt, looked at the business, and was like, yeah, they're going to be fine. And if you can't do that sort of research, I think it's going to be hard to know how to hold on to a stock in times of dire need. Like when you're getting offered it at the best price, because I think a lot of people imagine that when the company drops by half, the company's going to look exactly the same when it does that. And usually it's like some terrible bit of news has come out. And most people just have so much fear that they'll give it to you for pennies.
Oh yeah, they're afraid. Yeah. And actually we see the exact situation with PayPal. Nobody wants to touch PayPal stock, but I use PayPal on a weekly basis, and the service has not changed at all. Just some other competition, but I don't care. I just want PayPal because I trust PayPal with my money. And that's it. End of business. End of dealing with PayPal. I don't mind if the stock crashes 50%. That's okay.
Yeah. But their price earnings, that's one I've been flirting with picking up for a long time. It's just teasing me, and it keeps getting cheaper. So what's the price to earnings at now for PayPal? I just want to take a look. It's 15 last time I looked.
Yeah, it's around 15.
And like that's a funny one because I think I don't really know what triggered that downfall in PE. It went from like 30 price to earnings to 15. I think it's just increased competition.
And lack of growth.
Yeah. And so I don't really see PayPal growing. But they're on eBay, they're on lots of websites. I've used them quite a lot recently. And so they're not going away.
Nope.
They're going to be doing well.
There are other competitors that offer lower fees, but it's already low. So people don't mind paying extra for PayPal. And the salad oil scandal can happen. We've seen the same situation for Meta. Nobody wanted to touch it. It can happen again and again and again. If just for that, for China, it's been the case for 2 years or 3 years. I think Munger bought the first position in 2021, April. So 3 years. Here we are. The stock was at 200. Now it's at less than 100.
Like 78 or something.
Good enough. Good enough for us.
Got things like Alibaba, who have a solid thesis as to why that's worth holding on to, and been buying as it goes down. But I had a big mistake, which was Cineworld, which I miscalculated the debt on that, they went bankrupt.
Oh wow!
So that was a UK cinema chain, and they kept on going down in price. And I was quite confident that people would return to cinema because just people always. All the while during Netflix, during DVDs, during the rise in cheaper TVs and all of this, cinema had just been performing better and better as well. And so I made an assumption that the bigger streaming was, the bigger cinema would be. But the pandemic just destroyed it, tore it a new one. And I thought they might come back. I thought people would come back to cinema, and they didn't. So that was a big mistake.
Yeah, the industry was completely destroyed. And I wonder even now why AMC was such a meme stock. Who wants to invest in a cinema company? I don't know. GameStop, okay, I understand they are gamers. That's part of their culture. Okay, they go in herd. But for cinema, I don't understand. I don't understand it.
Well, they make absurd margins on Coke and popcorn, absurd margins. And so that's where the money comes from. And they don't have to pay for the films to be produced or anything. So they just pay a set fee to have this film in the cinema, and then they charge 20 quid for popcorn, which costs 10p.
Well, you can say the same for every cinema, no?
Yes, yeah. All cinemas are good, but I mean, the issue has been the reason Cineworld was my choice was because that's the one in my country, for a start, and so I could go to the cinema and I could check out how many people go in there, and I was reasonably satisfied that there were enough people in the cinema, but maybe I was just deluding myself because of films like Avatar, but they were just the cheapest price. They were the cheapest price, and they had the least. But they also had an absurd amount of debt. But the debt was from purchasing Regal Cinema. So anyway, it's not very. I don't think it will be very interesting to your listeners. But yeah, AMC to me didn't look as profitable as Cineworld, and so I assumed Cineworld would have more growth.
Okay, so you have different kind of cinemas inside the cinema industry. So I assume you have more premium cinemas, like a premium boat, but for cinemas. Maybe that's the kind of business, like the Ferrari of cinemas. Maybe that's higher margin business.
Well, IMAX is kind of that, and they're doing very well.
Is that a public company?
They're a public company as well, yeah.
Called IMAX?
Yeah.
Okay, I'll look into it.
The thing that people, I think, miss is they believe internet companies are the only companies that can get decent growth, and it's not really the case. It's just the fact that the internet only existed 20 years ago. So, and when you create an internet company, it very quickly goes from no users to 7 billion users, or however many people are on the internet. And I don't think anyone's going to perform. I think like Warren Buffett made a lot of his money from Coca-Cola and stuff like that. But the world isn't going to go. When Warren Buffett was born, I think the world's population was 1 to 2 billion. And now we're at 8 billion. And the world isn't going to go to 16 billion. The birth rate is too low. Almost all the people that are, like, we're close to our maxed out population. And so I think it's a changing time. But like Ray Dalio calls it the changing world order.
Oh yeah, exactly. Yeah. We were talking about growth, and it reminds me that in your portfolio you have a company that is not growing at all. The Volkswagen or Volkswagen or BMW that you have on your portfolio?
I've got Volkswagen. Yes.
Okay. Extremely hard company to understand. Like,
yes,
the car industry is just a pain in the neck. And
so Volkswagen, you value them like a bank. So their assets. So the way that people pay, they have a finance division, and the way that people buy a Volkswagen car is they don't spend 40 grand on a Volkswagen car, or the dealerships don't pay 40 grand. What they do is they take a loan out for the cars from Volkswagen and then pay that back monthly. And so the way that you look at Volkswagen's earnings is their assets and their liabilities. So Volkswagen will borrow euros to produce the cars, and then they'll loan them out. And basically, the bigger the gap between their assets and liabilities is kind of their earnings. But you're right in the sense that hasn't been growing as much as we would want it to be. And so, but the thing that I think is going to change is we are in kind of the worst possible time for Volkswagen, because you're going from being a world leader in ICE cars, internal combustion engine cars, to electric cars. So they're going to have for an interim time 2 production lines, which Tesla doesn't have to can have just 1 production line. And so that is one of the reasons that I do absolutely love Tesla, but they've never been priced affordably. And then also what I love about Volkswagen right now is they're going to be they've got a lot of money and they're going to invest that in developing battery technology. So they'll be producing batteries. And so they've got electric cars that are coming out now and they are selling, they're doing all right. But once they're producing their own batteries for them, which is the most expensive component of the car, and also Volkswagen sell a lot of parts to other car companies, and BMW and stuff like that, they're not going to be producing their own batteries. They'll get them from Volkswagen. And so once they're doing that, they'll be producing what should be a quite high margin product, a bit like Coca-Cola for cars. They'll be getting VW batteries. And the question is, can Tesla scale up their production for the world before Volkswagen scales up for Europe? And so,
oh, that's a good question. And before Chinese batteries come to Europe too.
But there are very few companies that are even motivated to try and do that. Volkswagen is one, because they produce cars, are extremely motivated to do it, and they've got a big enough size.
Yeah, is that the high margin product? If you want to create more batteries, like, I don't know, the price of the battery, is that a high margin product?
So typically when you have a product that is just so a car is custom designed. Everyone that orders a car is custom designed. If you've ever been to a car factory, what they have is red door, yellow door, blue door, black door, and there are lines like 50 doors long. And when the car comes, it has to be the right door for that car in the order. It's incredible how they do it, but at one level of customization, and it's going to get way harder to get margin. And so it's all to do with how many competitors can do it and stuff like that. And I don't think there are going to be, I think there's going to be like 3 battery companies, and there are going to be, 3 battery companies. And then the product is identical every time. So you're producing a car, may have, I don't know, 10,000 batteries in. And so you're producing 10,000 of the same exact battery. Is whether they can catch up with Tesla's technology. And also, I think I'm interested to see. So the stock market has been like booming recently because inflation's going down, which I hate the term inflation falling, and that's the video I'm doing at the minute, which is a bit of a take down on a BBC article which says inflation falling 3.4%, and then cost of living crisis improves as inflation falls. They did 2 articles, and it's just so misleading because it really heavily implies that prices are going down, the cost of living is getting better. And no, inflation falling 3.4% means that if your food shop was £100 a year ago, it's now £103.40. That's what inflation falling means, which is so misleading. The reason it's falling is because in 2021, your food shop may have been £100. Then in 2022, inflation was 10%. So your food shop was £110. And now your food shop is like £113.40. And that's inflation falling.
Yeah.
This is all the excuse the central banks need, it would seem, to now lower interest rates, which is something I didn't know how desperate they would be to do that. But I believe the Fed and the Bank of England, which basically copies whatever the Fed's doing, are saying that they want to lower rates 3 times this year. Whereas if it were me, and I'm glad it isn't me, but if it were me, I would want to hold rates at this level for a long time until we're back to 2% inflation.
Yeah.
But they want to do this soft landing approach, which essentially means inflation continues to rise at 2%. And so I think what they're thinking is if they the way that they measure inflation is in 2021, prices were 100. Now in 2022, prices were 110. And obviously now in 2023, prices are 113 or whatever. They're measuring from obviously the new price. So 2% interest is like 2% inflation will be like 115 pounds. And so they don't care about prices of everything going up. And in my video will be analysis on if you went from 50K in income in 2004 in the UK to 100K income in 2024. And that is higher than the average person, the median wage increased in the UK. But because the taxes on 50K were like 14%, and the taxes on 100K are like 27%, your earnings, if tax wasn't a thing, your earnings would have only gone from 50K to 57K. But because taxes are a thing, your earnings have gone from your tangible earnings have gone from 50K to about 43K or something like that.
So you'd rather not get to 100K and just keep your 50K, improve a little bit. Oh yeah,
it's why it's so important to have your savings growing in value, because if you had say $5,000 in a bank account and did nothing with it, everyone does something with it, but if you did nothing with it, it's going to go down to 29,000 by the time you're 2,900. And so if you invest it, you can outperform inflation quite easily. And in fact, they go with inflation because their earnings are somewhat dependent on inflation. So that is why investing is so important. And it's so effective that a lot of people are able to work less as a result of investing.
For your eToro copiers, I suppose some of them are from the UK. Do you get like specific questions like this? Do they ask about the tax regime or inflation as a UK citizen?
I see the articles do well on the internet, so that's just something I'm interested in, and I generally trust that if I'm interested in something, then some people will be out there.
Okay.
But I don't get asked much about interest rates and inflation. I think that's kind of a late stage question for a lot of people, a lot of investors. A lot of questions that get asked are like, basically, how do I buy a stock and a share and stuff like that at the beginning, or they generally go like, oh, should I buy Nvidia, or what's the next Nvidia?
What's your answer? What's the next Nvidia? Get your crystal ball and tell everybody.
In my opinion, it's Crocs.
Crocs.
Yeah.
Oh yeah. I think that's your second biggest position, Crocs.
Yes.
And
it's grown 40%.
It's a simple product, good business.
Yes. Well, they produce a foam clog which probably costs like £1 to make, and then they sell it for 40 quid. Yeah. And they've got a lot of brand. Like a lot of people want to be seeing the Crocs shoe, like they don't want to be seen in like a Primark foam clog. And so it's a bit like Coca-Cola, where a lot of people were very happy to pay a little bit of a premium to have the brand.
Yeah, but what changed about Crocs? I mean, I just discovered Crocs as a business because everybody was talking about it in 2020, 2021. But the business, I know the shoes, and I've known the shoes for years and years. What changed during the pandemic?
They changed in 2017 specifically. They got a new CEO, and what he did was he stopped doing all the different varieties of shoe, and he made it a mission to get the amount of stock down to as little as possible. And so they actually sell out of things occasionally. And what that did was drive up the premium, how premium the brand seemed, and stopped doing, and it meant that they didn't do so many offers. So previously Crocs were doing so many offers that they were seen as a cheap shoe. And then the second thing that happened was the pandemic, and people they wanted comfy shoes at home. Like there's a bigger audience for comfy shoes at home.
That's the bull case.
Yeah. And then they went on holiday after the pandemic, and they took their Crocs with them. So I think that's what I kind of think that happened. But I think the new CEO in 2017 really changed things around and made the brand seem more premium. Now they're showing up in films on Brad Pitt and stuff like that, which is, places they've not been seen before. They come out in a very different way. And I don't think it's going away. I've just traveled all around Asia, which is a market they're trying to break into, and they're everywhere. So,
the Crocs shoes or other products?
They have shoes, sandals, it's all footwear, and then they have these things called Jibbitz, which go in the hole, which cost about £5 or like 10 quid for 3 or whatever. And so I used to work in product design in retail, and I can tell you now that they're not paying 1 cent for these things to be made, and they're selling them for like a £5 or £10. It's the most incredible margin business you could ever ask for.
Oh wow. What's the yeah, just we will finish on Crocs, but I have another question for you after. What is the best business you've seen out of, you've been investing for years, but that's the next question. Just finish on Crocs.
The best one in the last 5 years, the two best investing opportunities I've seen in the last 5 years are Bitcoin and Crocs. And I'm not joking about Crocs being
As
the
someone
second.
who has Benjamin Graham in his bio, one of these two opportunities is very bad, and one of these two is very good.
Yeah. Well, I know lots of people won't agree with me on the Bitcoin one, but a lot of value investors. But I just think we are looking at the different currencies as products, not as different, not looking at them as what do people trust the most or what's the oldest, asking the question, which is best, and factoring trust and stuff in. A currency that people can't just print makes so much more sense in terms of not your day-to-day spending, because the transactions fees are high and all of that. But if you wanted something your paycheck to be in, then theoretically, Bitcoin is better. Or if you're a big company that is international and you're constantly dealing with the dollar dropping in price, the pound dropping in price or going up and stuff like that, and you want something as a store of value. When you think in terms of value, I think when in 10 years' time, there'll be more or less the same amount of Bitcoin. But in 10 years' time, there'll probably be more housing and stuff like that. And so you've got the same amount of Bitcoin, but you've got more housing. So the supply of my Bitcoin has stayed the same, and there's more housing. And in the UK, I personally believe that the housing market is about to go down because of a few things colliding at the same time. And one thing's for sure is the government are going to print more US dollar and GBP and Chinese yen than is going to be produced in Bitcoin. So in 10 years' time, there is just going to be more supply of that versus the Bitcoin. And then what comes into it is trust. So trust does come into it. That's the biggest advantage of the US dollar, is people have trusted it for a long time, and people have a lot of trust built into it. But that trust is built on the US dollar performing well. And now that we're moving from oil being the dominant source of energy for our planet, and possibly moving to solar and wind and all these other things, the US dollar won't have that that advantage that it had
take
before.
A lot of decades to move from oil to energy. Maybe we will not live enough to see this change.
I'm not sure that I think we'll see it well within our lifetime, very, very soon.
Oh yeah, you want to take the bet?
30 years. The thing is, it's exponential, and so the more electric cars there are, the more energy you can store, and that's the biggest issue, is energy storage. And then also we've got wind turbines in Brighton. We have and there's about 200 of them, and they're about to build another 200, I believe. The new 200 that they're building are half the price and twice as energy producing. And so it's exponential. So what you've got, you don't have just exponential energy increasing, you also have increased energy storage. And then also the electric cars of the future will be more energy efficient. And you might have things like driverless cars as well. So what you've got is the cost of renewable energy coming down, and the demand on the national grid going down also. Potentially, I could be wrong, but there was a time, I mean, it was only in the last 100 years that we became so dependent on oil. It was I think it was like the biggest industry before that was beavers or something.
I think with all these solar panels that we see, I've talked to a friend about, he wanted to invest in a company that produces sort of, not aluminum, but something like this. material to produce solar panel. It was like a Chinese company producing
Clever.
loads of free cash flow, no debt, just cash heavy with a lot of earnings, good margins, and they help China produce solar panels. Maybe there could be some opportunities there. If the markets for solar panels is going to have a boom, they are going to make a lot of money.
For sure, for sure. I would quite like to see it in like a big investor's portfolio first, say Manish Babrai or something like that, because it's tricky work getting the actual contracts for them and also learning the reputation of the company and the CEO. Whereas like with Greggs, for example, I don't have to do that research because I can just walk into the shop. And so to understand
That's work. That's work.
So yeah,
That's work.
But that's work I do for free. So working out what the like how likely is it that this aluminium producer is going to be is not going to run out of aluminium in the next 10 years, is going to be it's a perfectly valid way to invest. It's just not something like I struggle to do that sort of analysis on a stock sometimes.
Yeah, it's quite difficult. I think it was not aluminum, but like polysilicon or something like this, but just a component of it. And it was just too hard. We went to the annual report together to see how everything works. Okay, the contract, they had like 3 customers in China, Chinese government. Okay, there are many variables. We don't know if in 5 years the business will continue to sell as many silicon as they do now. Nobody knows, but just the PE is at 3, 4, 5 producing.
Oh yeah.
They are
ping
net
it to me.
cash. Enterprise value is negative because they have more cash in the balance sheets than their market cap. So if they want, they can buy back the entire market cap, but it's a Chinese company, so they will never do this. But okay, no debt and enterprise value, which is negative, with a strong business model on the promising industry. Lots of things to like, but it's in China, so you don't know if the numbers are 100% correct. You don't know if the industry will collapse or not. But yeah, I think if you get the same
you've got to look. The only thing I would say
great.
to look out for on that is there's a lot of Japanese companies that have loads of cash on the balance sheet, absurd amounts of cash on the balance sheet, and they have really low prices. But it's because they rarely ever give the money back to shareholders. They like to keep the money in the business and like to be super conservative and prepared for the future, which is an amazing thing. But that's a big thing for me is like, are you going to return this money to me? Which a lot of people seem to not care about these days.
Yeah, and that's why a lot of Japanese companies have a P of 5 and they are net cash. And every year there are some US investors, US analysts that come to earnings call and say, okay, what do you do with the cash? Just pay dividends or buybacks. And I say, no, that's not part of culture. We just use it in case there is a crisis, we can survive. Okay. I see a lot of beginners in the stock market. They do the same mistake of thinking this, investing in Japanese companies, thinking there will be buybacks and dividends. They are still waiting for buybacks and dividends. You have to be really patient.
I mean, they might be an amazing thing to hold in the event of a worldwide market crash, but otherwise they are being too conservative. Several big things have to happen all at the same time.
And that's crazy, and it will never change. I mean, if you don't have regulation like we see in Japan that incentivize people, companies to do some buybacks, if you don't have this official regulation, official incentives, they will never do buybacks. They will never do dividends. We see the same in Korea.
This is where Buffett and stuff, their advantage comes in because he used a bunch of, while debt was super cheap, crazy cheap, they did things like they borrowed lots of money at like 1% or whatever, and then bought Japanese companies that had a 5% yield or whatever. And they just liquidated them basically, and then really quick money.
That's an easy bet. Like 5% return for 10 years, very easily.
Yeah. But we, us as small investors, we don't have that power. We can't buy the whole company and then say, right, we're going to take the cash out of this thing.
Oh, and we want
Yeah.
more than 5% because we are young and we are hungry for more. So
Well,
we will
we've
not
got
be
more
satisfied with
opportunity than Buffett
5%.
does. Yeah.
Oh yeah, we are way smaller, so we
Yeah.
can get more opportunities like Crocs, like like see
Yeah.
the world, all this niche stuff. That's why, that's how we will make 20%, 30% per year if
In
we
my
play
video on
hard.
Crocs, I did like if Warren Buffett bought the whole company and it doubled from 6 billion to 12 billion in market cap, that would barely increase Berkshire's share price by like 1%.
Yeah, absolutely.
So
Doesn't move the needle at all.
yeah, so he needs to buy like all the oil companies in the US to
I know, just, and he said in the latest letter that the future returns for Berkshire will be even smaller and smaller. But he has been saying that for more than 2 decades now, that
yeah,
the big size is just an anchor, and that's a minus to your performance. You will not
yeah.
get as many opportunities
Well,
when
he
you
has
grow.
been right. Like Berkshire has not been growing at the pace of its younger self.
Oh yeah.
It has been shrinking in terms of its earnings growth. It's just remarkable that a company that size has been growing 20% annually.
Yep.
Yeah.
It's just almost impossible. It's not in cloud, it's not in tech company. Maybe Microsoft can grow 40% per year. We've seen this in 2020, 2021, cloud,
Yeah.
etc.
He's got Apple shares, to be fair. That was an incredible pickup back in like 2012 or something.
Oh yeah. By the way,
But
out of all these 13F coming from Berkshire Hathaway, have you found some good opportunities out of this bunch of maybe 30, I don't know, 30 stocks, 40 stocks, I don't know how many stocks he has.
I look at
It's a
quite a
good
lot of
hunting
them.
ground.
I look at quite a lot of them, but given the fact that I'm looking for companies I recognize, that's a much smaller collection of stocks for a start. And so, yeah, I haven't found a lot of companies recently. I think everything's a little bit expensive right now, which is a shame.
And you want to focus in the UK, right?
That's just what I mean. If I can find a growth stock, like Crocs's return on investment capital is 40%. So if I can find, that's a growth stock. That's faster than Apple. So if I can find a growth stock in the UK, that's great news.